We all know the path of entrepreneurship is full of hurdles. Sometimes you need to jump over them, sometimes you run right through them, but the best entrepreneurs seem to find a way to turn them into launch pads. They also subscribe to this channel. This is a story of how an entrepreneur turned a $10 million hurdle into a $2 billion opportunity. Cue the story music. After Northwest Airlines released the first seatback screen in 1988, our entrepreneur of the day, none other than Sir Richard Branson, knew that individual screens represented an opportunity to gain advantage over his main competitor, British Airways. Branson had only recently started Virgin Airlines 4 years earlier in 1984 in response to his frustration of being bumped off of a British Airways flight. So he wants to be an early adopter of rear seat entertainment systems, and his team estimated that the cost to install the screens across his fleet would be about $10 million. So they go to the banks to get $10 million, which, I think is not a huge amount of money when you're in the airlines industry, and not a single bank would give him any money. And that's a problem. He strongly believes that rear seat entertainment will strengthen his competitive advantage, but he can't get funding for it. So how does he solve for that? Well, his strategy is pretty brilliant. One night he's laying in bed desperately trying to figure out how he can get $10 million, and a light bulb turns on. That same night, which is morning time in Los Angeles, he makes a phone call to Boeing and says he'd like to purchase 10 brand new 747-400s. These are the big jumbo passenger jets. And Boeing is ecstatic because each one of those planes costs about $200 million. Then Branson also explains that, as part of the deal, he'll need these planes to have seatback TVs installed. And for Boeing, this is a no-brainer, of course. We'll add that to the bill. Now, on the face of it, this may seem like an absurd strategy. Like, how does that phone call even go? Hey Bang, remember when you wouldn't give me $10 million? Well, you drive a really hard bargain. I'll be happy to settle for $2 billion. 200 times Branson's initial ask. Well, he goes to the banks and has absolutely zero problems getting $2 billion from them. And in 1991, Virgin Airlines introduced to its existing fleet 10 brand new 747-400s that were years ahead of the competition. But why did this work? Why weren't the banks willing to lend $10 million, but were perfectly fine lending $2 billion? Now, I should say that I don't know the specifics of the banks financing or not financing Virgin Airlines, so this next part is only my view on why the banks may have acted the way they did. So let's briefly talk about getting a loan from a bank. The first thing to note is that when a bank lends you money, it turns out they really want to get it back. So if you want money, they're going to do an analysis to determine your ability to pay it back. And among many factors that banks consider when dishing out loans, there are two I'll focus this discussion on today: collateral value and financial performance impact. Let's start with the first. Banks are always more willing to loan money out when the loan is collateralized or secured, because they know that if the borrower defaults, they can use the collateral to get back at least a good chunk of their money. Mortgages are a good example of secured loans. The bank loans you the money for the house, and if you fail to pay, the bank takes your house and sells it to make their money back. When loans have no collateral or are unsecured, the loan is viewed by the lender as riskier. Credit card debt is a good example of common unsecured loans, and explains in part why interest rates on credit cards are typically much higher than your mortgage rate. A second factor banks consider is how acquiring this proposed asset will impact the financial performance of the business. When a business is borrowing to acquire an asset that very obviously improves earnings potential, banks are more willing to lend because they understand that improved earnings means greater ability to service the debt. Now, if a business wants to borrow $1 million to install a gigantic chocolate fountain in the lobby, the bank might struggle to see the sweet side of the deal. They might prioritize high collateral in that circumstance, or perhaps decide the deal is just too rich for their taste. Okay, I'm done. Now, with collateral value and financial performance impact top of mind, let's re-examine Branson's initial ask of $10 million to install the seatback TV screens. And now we start to see the problem. Like, what exactly is the collateral here? The TV screens themselves likely had very low collateral value. Like, what is the bank gonna do if they default on the loan? Rip these out of every seat on every Virgin airplane? And even if they did do that, who would they sell this very new, not yet popularized product to? The plane itself was probably already being used as the collateral for the purchase of the plane. And similarly, given that Virgin was a newer airlines, their balance sheet may not have been flush with unencumbered assets to act as collateral. And what about financial performance impact? You can certainly make the argument, as I'm sure Branson did, that having these seat-back TVs could drive consumer preference for Virgin and allow them to take market share away from British Airways. But the banks very likely would have taken that with a pretty big grain of salt, since at the time it was an untested hypothesis. The connection of seat-back TVs to improved financial performance was probably just too loose. And so it's not a huge surprise that Branson's ask fell flat. And now we can start to see that the ask for $2 billion for new planes, at least as it relates to collateral value and improved financial performance, was an ask that the bankers could feel much better about. The planes themselves had high collateral value, and expanding the fleet very clearly represented higher earnings potential. Not to mention that these new planes would be equipped with cutting-edge technologies like seatback TV entertainment. So what's the takeaway here? Well, firstly, I'd say that when going to a bank for funding, demonstrating your ability to pay back the loan is far more important than the dollar amount you're asking for. Secondly, subscribe to my channel. And lastly, I'd say when you're in business, innovation isn't limited to products or services. It often needs to extend to most every aspect of your operations. Branson's story isn't just about in-flight entertainment. It's a testament to thinking outside the box, aiming higher, and effectively redefining the challenge itself. As you navigate your own entrepreneurial path, remember this: every obstacle can be an invitation to innovate. Everyone knows the common saying, if a door closes, another opens. But in business and in life, it's just usually not so straightforward. Sometimes when a door closes, the solution isn't waiting for another door to open. It might be that you buy the whole building. So what creative problem solving have you been involved in lately? And what content should I make next? Share your thoughts and stories below, and I'll see you next time.